Hey guys, John from Gutenberg Research here, and in this video I'm going to take you through our Facebook earnings model, and I'm going to show you how I've calibrated this model to meet management's guidance ahead of this week's release. And I'll also show you how to run sensitivity analysis using your own assumptions and changing some of the key inputs that I've made into the model. So for this, we're going to use the details from the last quarter press release. So if you go to the Investor Relations homepage and click on the past events and then download the transcript. Just blow this up so you can see it. And then the outlook that management gave starts on page 8. Right here where they say, now turning to the outlook for the remainder of 2016. So I'm going to plug these items into our earnings model. And if you'd like to download the model, it's available on our webpage, gutenbergresearch.com. If you click on the Facebook tab and you just click this icon to download the Excel file. So I already have the Excel file queued up. And before we get started, we should just go through how it's structured. So you'll see some dark gray columns. Those represent the historic actual periods, and the light gray represents the future forecasted periods. Anywhere you see orange cells, those represent consensus estimates. So you can see I've calibrated the model to meet the consensus revenue and EPS estimate. And then the top section is the income statement. And the income statement is fed from assumptions in the segment details down below. So you can see that I've broken out the results into monthly active users for each one of the geographic regions. And I use quarterly growth rates to get to the total user counts. And then I have the ARPU, which is the average revenue per user for each one of the regions. And just by multiplying the users by the average revenue per user gets you to sales. So that's a top line revenue estimate for each region. And then that feeds the income statement up above. So you can change these blue cells, which represent the key inputs into the model, and the changes that you make will automatically feed through earnings and valuation. So below the user counts, we have some ratio analysis. And so this is where we basically make our assumptions to finish out the rest of the income statement. And you can see that we do each one of the operating expense lines as a percentage of revenue. So you put those estimates in here. Effective tax rate, and then some small additional items. Below the ratio analysis, we have our non-GAAP adjustments. So we have some assumptions for stock-based compensation and amortization of intangibles, and then tax impact of those items. And those feed into the non-GAAP rows in the income statement up above. And then you'll see throughout there are some purple cells. So those purple cells represent management's guidance. So that's what we're going to take from the press release. Below the segment details, we have a balance sheet and a cash flow statement. If you're doing only a price earnings multiple, you don't really need the details there. If you're doing a DCF valuation, you will have to forecast out results for both the cash flow and the balance sheet. And then we have the details of our two valuation approaches. So we use a 50-50 weighting of our price earnings and a 50-50 weighting of our discounted cash flow valuation. So going back up to the segment details, and we can go back to the press release too to get the details from management. Okay, so they give a little bit of color on revenue here. They don't really give too much guidance. One thing that they did reiterate was that ad load growth was going to decline in the back half of 2017. And that was a point that they had first brought up on the June conference call, the second quarter conference call. And there are a couple of potential offsets for that. So one is the increase in demand from advertisers, the time spent per user, anti-ad blocker efforts on desktop, which have been pretty successful. We've seen desktop earnings come back quite a bit. And then there's the shift from desktop to mobile, which is actually a favorable shift for Facebook, which is not really the case for most internet companies. But Facebook shows only higher price feed ads on the mobile platform. So it's actually a net benefit to revenue. Another thing we'll be watching for is expense control. So we've seen a lot of advertisements for Facebook Live in this quarter. And we also know from the press release and the conference call last time that they're going to be adding some significant headcount in the for their engineers. So we'll have to keep an eye on the operating expenses. For right now, we've modeled it to meet the guidance that they gave. So let's get down to where they actually give some quantitative guidance. So on the revenue, they don't really give guidance, specific guidance. So we just calibrated that to meet the consensus estimates. In fact, I guess I should show you how I've done that. So you can see the orange cells, again, consensus estimates, and I'm just taking the total from each region. So it's really a function of our growth rates in monthly active users and the average revenue per user. So in the fourth quarter of December, you can see that I have a growth rate in total user count of 1.8%. So that's up from the September quarter, which had 1.3% for US and Canada. And then I have that coming down in 2017. So it's basically hitting the fourth quarter plateau and then coming back to stable growth rates similar to what we've seen in 2016 and the back half of 2015. Then in Europe, similar trend. We have greater growth, but then plateauing and staying flat for the rest of 2017. For Asia Pacific, same thing, 5% growth for the rest of the world. Then for average revenue per user, I have it reaching a quarter high of $18.35. So we tend to see in the fourth quarter that you get the highest average revenue per user. So you can see in the fourth quarter of last year, ARPU went from $10.50 to $13.50 in the US and Canada. And in Europe, it went from about $3.50 to about $4.50. So I've incorporated that type of seasonality into my inputs for the December quarter. And I tried to build in seasonality for the rest of 2017 as well. So you can see it comes down from the high in the fourth quarter and then spikes back up again in the fourth quarter of 2017. So that's how I got back to the revenue estimate. And then for expenses, if we go back to the transcript, they basically narrowed their expense guidance for the rest of 2016. So they expect that the expense growth rate will be at the lower end of the prior range of 30 to 35%. So if we go here, you can see that I've built in an equation that takes all of the assumptions for the OpEx expense line items, and it just calculates the year-over-year growth rate. So you can see that, and I put the comment with management's guidance in there. You can see I have it modeled at the low end at 30.6% year-over-year growth. And then on a non-GAAP basis, I have it at 41.3%. So let's go back here. And I believe that they also gave it on a non-GAAP basis. So you can see in a range of 40 to 45%. And then in between there, they do give some details of what those non-GAAP items are. So they expect full year 2016 amortization expense of approximately 700 to 800 million. And you can see if you go to my amortization line item, I have that at 750 million, which is the midpoint of management's guided range. And they expect 2016 share-based comp to be between 3.2 and 3.3 billion. And again, I've calibrated that to meet the midpoint of management's range at 3.25 billion. And then they also give some guidance for capital expenditures. So that is on the cash flow statement. Again, if you're only using a price earnings based multiple, you're not going to be worried about what the CapEx is. But here it is here. You can see that I've calibrated it to meet that guidance that they gave at 4.5 billion. And you can see that's quite a significant investment up from 2015 of 2.5 billion. So that's all of the guidance that they gave. They also expect tax rates to be in line with the year-to-date tax rates, which is what I've incorporated here. So when I put all those estimates in, you can see I get back to the consensus estimate of 129, which is not really surprising. It's basically saying that the street is in line with management's guidance. And using my assumptions for the rest of the year, I was able to get back to the consensus estimates for the first, second, and third quarter of next year. So next, I want to show you how to run sensitivity analysis. So maybe you are thinking that the expenses, the operating expenses due to their marketing campaigns are going to be a little bit higher than what management is currently guiding to, or maybe you think it's going to pick up in 2017. So maybe you want to just make some changes to the marketing and sales expense as a percentage of revenue. So you can increase that by just changing this cell. So actually, before we start even making any changes, notice that our 50-50 weighting of the two valuation approaches comes out to 131. And I'm just going to take note of the next 12-month EPS estimate. So this is 498, which I'll just put here. And I'll sum these up so we don't have to do it again as we make changes. Okay. And this is 131. Whoops. Okay, so now we can make changes and see what happens to these estimates here. So I'm going to change the operating expense, or I'm going to change the marketing expense as a percentage of revenue. So I'll increase that to maybe 15%, 16%, 15% in the second quarter of next year. 15, and we'll just keep it at 15 there. So you can see that the EPS came down to 483 from 498, and the valuation came down to 129 from 131. But maybe you think that the monthly active user growth rate is going to increase. So let's bring this to 2%, and maybe next year it goes to 1.5% in the first quarter, and then up to 2. So you can see that had an offsetting impact that brought up EPS a little bit. Let's even bring it up a little bit more. So we'll bring the growth rate in Europe to 2%, maybe Asia Pacific to 5%, and we'll call this 6, 7. So we'll have a pretty significant growth rate in Asia Pacific there. And let's bring up the ARPU in Asia. 3. This to 6. So you can see by having that stronger growth rate and the higher ARPU, that's brought up the EPS above 498, the 498 original. So we had at 507 now from 498, and that's higher operating expenses, but higher ARPU and higher growth rates in users. And that brought the share valuation up to 136 from 131. So you can see how you can pretty easily run some sensitivity analysis. And this is also very useful right as the press release comes out, because you can update these results and then put in the guidance. So management will probably give guidance for full year 2017. So you can plug that guidance in, calibrate this model to meet the guidance, and see instantly what the impact is on share valuation. So that way you can tell if the price move in after hours makes sense or not. So definitely check back after the release. I'll update this model. Probably won't post a video, but I will post the model on our website. And thanks for watching. Good luck with the rest of earnings season.